Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Rosine. Thanks for joining me today. I'm going to be reporting flows initially for the conventional fund business for the week ended September 11th, 2013. You know, we actually had a pretty good market week. Market was up about 2.65%. That'd be the Dow Jones Industrial Average. We had three consecutive days of actually triple-digit performance for the Dow Jones Industrial Average. So it was really quite a strong week. And this was on news of the Russian negotiated settlement with Syria, and also on the outlook that the Fed may just decide to not pull the trigger so fast, take money off the table because they had softer employment numbers. Let's take a look at what happened in our macro group to see where the funds actually occurred. On an equity level, we take a look at it. We saw $3.7 billion of net new money coming into their coffers. On the taxable bond fund side, really kind of a ho-hum type of week. Only about $100 million of net new money into their coffers. Muni bond funds got slapped around again, about $1.8 billion out of their coffers. And money market funds took in $13.2 billion. So really the net for the week was about $15.2 billion of net new money coming into the conventional fund business for this week. Well, let's take a look at how that panned out actually on an equity basis. We saw equity funds were up 2.89%. It's the second consecutive week that we've seen plus side performance, and they saw $3.7 billion of net new money come into their coffers. And if we take a deeper dive into that, it's a 36th consecutive week that we've seen flows coming into the equity group. And how we break that out is domestic equity funds, so about $1.8 billion of net new money, and then we take a look at the non-domestic equity funds, so about $1.9 billion. So it was actually a very good story for that. It was a 15th consecutive week that we've actually seen net new money come into the non-domestic side. So investors really have been warming up again to the international end of the business. If we take a look on the domestic side, however, large cap funds saw about a little bit over $1 billion of net new money come in, and that's the large cap funds. Now, if we saw the next group, it was actually small cap. So people were willing to put a little risk on their portfolios this week, and that certainly boded well for the international community. International group saw about $1.7 billion, and of that, only about $366 million was of emerging market type. So really, it was the domesticated international funds, not necessarily the emerging markets of that group. Let's take a look now, though, if we take a look at the ETF side of the business. And if we look at the ETF side of the business, for the first week in 5, we saw inflows. It was about $9 billion. Big story. Again, people willing to put risk on their portfolios. SPY, the Spider S&P 500, saw about $3.9 billion net new money. iShares, MSCI Emerging Markets, saw about $1.5 billion net new money. But if we take a look, there was a little tale of two cities. iShares, at the bottom of this slide, iShares Core S&P Mid-Cap Fund saw about $400 million outflow, and the Market Vectors Russian shares saw about $166 million exit their coffers. So really, it wasn't all that big of a story as far as the outflows. What the big story was the amount of passion that people had for putting money back to work in ETFs once again. Again, after a 5-week pause of actually just taking money out, we saw them turn around and embrace, I'm going to say, really the settlement that Russia had engineered, and then also the idea that maybe we're going to come up with a new Fed governor and a new Fed chairman over the next several weeks. Hopefully, President Obama will come out and announce that shortly. Well, let's take a look at what happened on the fixed income side of the universe. For the second week in 3, we saw again inflows, but it was only about $100 million in their flows, and it was a third consecutive week though that we saw that there was plus side performance. It was about 0.5% return, and so it wasn't really anything to talk about, but again, we've had some good performances as far as plus side going. It's the 65th consecutive week that we've actually seen inflows into loan participation funds. That was one of the big stories here, and we saw that it was about $1.4 billion net new money coming into their coffers, and the next group down was flexible portfolio funds. So again, back to that equity concept, we look at the fixed income concept, you saw that people were willing to put a little bit more risk on their portfolios as they go hunting for both yield and flexibility. Loan participation funds offer really adjustable rates, and the flexibility of flexible portfolios go anywhere funds. It could be mortgages, it could be adjustable rates as well. Certainly saw that as far as inflows. Now, what we saw people take it on the chin, though, is really on the government side. Government mortgage funds saw a colossal $1.2 billion in outflows. This is a pretty big number for them as far as that goes. And the next group we saw was Treasury and mortgage-backed securities take about $600 million in outflows. So this was quite a story as far as people punishing longer dated and treasury oriented type of securities, but embracing again riskier higher yields, and also adjustable rate funds. Well, let's see how that's actually played through to the ETF side of the business, and then we take a look at that. On the ETF side, we saw about $1.2 billion of net inflows. Again, that's a pretty good number. For that, we saw the iShares 3 to 7 year treasuries taking about $610 million, and the iShares floating rate, again, this is kind of that, going after the floating rate securities, $350 million. And on the bottom side of this, we saw that TIPS and investment grade type of securities, longer dated treasuries, longer dated corporates, actually take it on the chin and lose some money. But again, pretty good flows, $1.2 billion for the week, and that was certainly something to talk about. Well, now if we turn our attentions to the pariah of the group, muni bond funds. Muni bond funds actually had a rough week again this week, about $1.8 billion in outflows. This is the 16th consecutive week that we've seen them get punished. Obviously, the story about Detroit is already out, but now we're hearing other extra stories that Puerto Rican debt is actually suffering some ill thoughts. People are taking a look at it and saying, listen, things aren't being managed very properly there. And so people are continuing this outflow, running away from munis. We saw, again, about $1.8 billion in outflows, and this is the first week in 6, by the way, that we saw positive returns, 0.04%, almost nothing to write up home about. And then really the big culprit here was national munis losing about $1.2 billion. We don't know when that's going to actually stop. This has been kind of a circular argument. People are just getting out of it, having problems with certain municipalities and getting out more, and it really hasn't subsided in quite a while. Now let's take a look at money market funds. And money market funds saw some big inflows, $13.2 billion. We can never ascribe any certain reason why they saw big inflows or big outflows, but certainly they saw big inflows. It's the 5th week in 6 that they've seen inflows. Taxable money market funds saw about $14.7 billion in net new money coming to their coffers. How it broke out: institutional investors put 13.3 into the money market coffers, while the retail investor put in about 1.4. But on the flip side, we saw that the tax-exempt money market funds, once again, 1-2 punch on the chin, $1.5 billion out. Well, as we take a look now and going forward with some of the news that came out, certainly we're going to keep an eye on Syria. Nothing's done here. Unreasonable demands are being met. I probably ascribed by both sides, but again, that's for politicians to figure out. The FOMC actually is going to be coming up in the next week. People are keeping their eyes on that. Will they go ahead and start tapering? We don't know. The odds are that they will start tapering. A lot of people are making bets so that they'll wait till December. The Fed is going to be announcement for the Fed replacement should be just right around the corner. And of course, the new argument now on Capitol Hill is going to be over the debt ceiling. So as these start to pan out, we'll certainly see how they impact flows. If you want to do a deeper dive, you can go to our website, lipperusfundflows.com, and do a deeper dive, or you can join us next week where one of our analysts will be talking about flows of the week. Well, thanks for joining me. My name is Tom Rosine, wishing you the best in your wealth planning and creation.